The stock market, as you say, is split into sectors, be it, for example, the oil sector or the gold mining sector, the retail sector, the banking sector. On top of that, of course, we have geographical sectors, whether it's the US, the UK, EU, China, and so on. It's very interesting that when you look at the US major markets, the German major market and the UK major market, being the FTSE 100, the top 100 companies in the UK, these are at very significantly elevated levels. They've gone up over 100% or so since over 4 years ago. But then you look at other countries, such as Italy or China, they're actually no higher or within a few percent of the lows of 2009. So there's roughly 100% difference in valuation between some countries in the West and some other countries, like, as I say, Italy and China. As a contrarian investor as I am, when I see a stock market which hasn't moved in 4.5 years, then I'm actually partially interested in it. Whereas when I see a market such as the US, which is up 120% over 4 years, then I'm disinterested, particularly to get newly involved in that. Now, say if I have investments there, then I'm delighted, I've made a lot of money. But maybe I should be looking at locking in some of those gains. The gold mining sector has been decimated in the last couple of years. Gold has come down about 30%. Gold mining has come down about 60%. And maybe, just maybe, we're starting to get to valuation levels which are interesting, although I have to say I still think there's further we could go down over the next couple of years in the precious metals arena. Long term, I'm particularly interested in Japanese equities, Japanese shares. The Nikkei index is still down about 70% from 24 years ago. And in Japan, they have massive quantitative easing, massive money printing. We believe as a firm that that's going to create significant inflation and possibly even hyperinflation in Japan. We believe that that will filter through to Japanese equities. So we are starting to get interested in that area.